MyWealth.com. I'm Mike Conlon. I'm one of the senior instructors with the courses. Welcome to today's blog. Today's blog is entitled Deflation and a Dollar, Round 2. Alright, so the oil inventory numbers came out yesterday, and there was an increase of roughly 5 million barrels. That was about 1 million more than the American Petroleum Institute, the API's estimates were. Alright, consequently, the price of oil plunged nearly 6% in its largest drop in nearly 3 months. But is this the whole story? Well, not exactly. Right now there seems to be a lot going on with oil, which could cause its price to drop a lot further in the future. Alright, according to the Wall Street Journal, commodity speculators, including hedge funds and pension funds, as well as ETF investors, were responsible for the wild oil price fluctuations. Now the CFTC has come out and they've stated that speculators were involved and in fact were material participants in causing the price of oil to reach $145 a barrel back in July of 2008. Alright, so now that the price of oil seems to be coming down, alright, can we be certain that that this price is based solely on supply and demand? Well, it's not likely. There's probably some other reasons why oil's prices are going to be coming down and how that's going to affect the markets overall. Let's have a look.
As always, be sure to check out the written blog at www.mywealth.com/blog. Okay, so the Commodities Futures Trading Commission, the CFTC, is pushing for regulation in the energy markets. All right, now this isn't the first time we're hearing about this, but recently they've come out and they said that in fact speculators in the marketplace did have a material effect on driving the price of oil to the heights that it hit back in July of 2008. All right, and recently, about a month ago, there was also an article, or an op-ed rather, from Nicolas Sarkozy of France and Gordon Brown of England, who were also calling for regulation in the energy markets. All right, so whether or not these regulations are actually going to occur, or if they're going to have the intended effect that everybody thinks, namely by putting this regulation on it, they're going to be able to keep prices low. That's going to be up for debate, and we're gonna have to wait and see how that happens. All right, because while this is a seemingly popular move, that's if lower gas prices or lower oil prices makes that better for consumers, then that's a good thing. But in reality, by putting the caps on oil, this could have a detrimental effect on other areas of the economy, and let's see why that is. All right, just recently, China, on Monday, their stock market sold off roughly 5%, on speculation that China may reduce their stimulus program, thereby reducing their demand for oil. All right, one of the things that people were concerned about when the Chinese stock sold off, and it was a big move. It was about a 5% sell-off, which is that's a nice, decent-sized move. But they're talking that the stimulus plan that the Chinese government has put forth is starting to create bubbles. All right, it looks like they're having a real estate bubble over there. The stock market is gotten way ahead of itself. So they're thinking that they may reduce their stimulus. All right, so should this occur, it could be a sign that their growth is going to slow, and if their growth begins to slow, then that's going to reduce their need for oil. So if the demand for oil goes down, it follows that with the supplies that we have, the price should go down as well. All right, but anytime you're dealing with Chinese government and you're talking about the numbers that they're putting out there, sometimes I don't know if necessarily that folks necessarily believe the numbers that they're coming up with. So that when they say they're going to have strong growth, or that their growth is moving along at a certain clip, there could be a little bit of dissension between whether people believe that these numbers are true or not. So we'll have to wait and see how that plays out. All right, so let's take a look at a chart here. We're going to take a look at the S&P 500 index, the spiders, versus oil. All right, and what we want to show you here is that there's a basic correlation here between the U.S. stock market and the price of oil. If you look here on the chart, you can see the red line here represents the S&P 500, and the blue line represents the price of oil. And as you can see, it looks like they've both been moving in tandem. Now, this is a short-term correlation. Has this always been the case? Well, no. I mean, in these correlations, they can kind of come and go with the wind, and they can change depending. But once people get set in their ways with how these correlations work, then it's more difficult to get those correlations to break. So, anyway, that's kind of what we're looking at. So, if we're saying that the demand for oil is going to go down and that the price of oil could possibly fall, then it stands to reason that the U.S. equity market may do the same. All right, so what does that mean for other areas? Well, let's talk about the U.S. dollar. Okay, on this chart, we're going to look at the S&P 500, which is represented by the red line, versus the U.S. dollar, which represents the blue line. As you can see here, there's a bit of an inverse relationship. All right, so meaning when the U.S. Stock market's going down, okay, like from this point here, Jan 09 to March 09, all right, U.S. dollar's going up. All right, and when the market's going up, March 09 to here, to current, you can see that the dollar's going down. All right, and basically, this is a correlation that happens because it's called the flight to safety trade. Okay, and when people are confident in the U.S. market and U.S. stocks, then they're confident that the whole global economy is going to do well. So what that does is that allows them to go out and take on a little bit more risk than they normally necessarily would. So, for example, if you're thinking that the economy is well, you could go out and buy something like Australian dollars or something like that that's going to pay a little bit more interest. Okay, but when U.S. stocks are going down, all right, then people are fearful that the global economy is not recovering, and thus they're going to rush back to the flight to safety of the U.S. dollar. So that's kind of why you see that effect. All right, so what's going to need to happen? Well, either these correlations are going to need to break down, or we're going to see some deflation here in the country, and that could be, in the form of equity markets, could be oil, gold, it could actually be housing. I think right now you're seeing a lot of people talking about how the government's trying to prop up the housing market because of deflation. But if these correlations do hold true and the price of oil does come down, then we could see some deflation. So anyway, so don't wait. Get educated. Get in a course. Come to www.mywealth.com and check out our investing courses and our currency courses. It can really make the difference for you in learning about how some of these government decisions are going to affect your investments.
So based on these reasons, if in fact the price of oil does come down, all right, I would be a seller of the U.S. oil ETF, ticker symbol USO, and also of U.S. market indices, namely the SPY, the spiders for the S&P 500, the DIA, the diamonds for the Dow, and the QQQQ for the NASDAQ 100. And I'd also be a buyer of the U.S. dollar ETF, UUP. All right, because one of two things is most likely going to happen. All right, either these correlations are going to break down, okay, or the government's regulation and intervention is unintentionally going to cause even more deflation than they had originally planned for. All right, and this is why government controls on free market economies can have unintended consequences, okay, which can be more damaging than helpful. If the U.S. government truly wanted to reduce commodity prices and speculation, they would increase interest rates to stave off inflation and keep speculators from having to seek out ways to protect themselves from the government's destruction of the U.S. dollar. Right, by keeping rates extraordinarily low for far too long, okay, we're going to be moving in and out of bubbles for some time to come. All right, and let's just hope that this doesn't blow up in their face. All right, so to learn more about how government decisions can affect your investments, be sure to check out our investing and currency courses. So I'm Mike Conlon. Thanks for being with me, and I hope to see you in those courses.